Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500 and today is Electronic Arts Incorporated, ticker EA. Over the next few minutes, I'll discuss my thoughts on both the business quality and its valuation. First up, we have market cap of $35 billion, enterprise value of $35 billion. I like what I see here in the sense that they're both the same. That tends to mean the company is not leveraged, and that's a really nice setup to have for a potential investment. This is the operating in the entertainment industry. Let's read the business description. They develop, market, publish, and distribute games, content, and services for game consoles, PCs, mobile phones, and tablets worldwide. Some of its brands include Battlefield, Sims, Apex Legends, Need for Speed, and they license games from others, including FIFA, Madden, UFC, and Star Wars brands. The company licenses its games to third parties to distribute and host its game. So this is a game producer, markets and sells its games worldwide through digital redistribution and retail channels. So good to know, gives a pretty good overview of what they're doing. Beta of 0.85. I've certainly played some of their games, and they're certainly known for having some high quality content. Let's look at the return on invested capital. So this is an interesting chart to me. I mean, on the first hand, it looks kind of cyclical. I mean, you have a down cycle here into the Great Recession where they were unprofitable for 4 straight years. That's actually very poor. The fact that you can have a business that's unprofitable for 4 years in a row makes it really dangerous as a potential investment. That's unexpected. I didn't expect to see that in their history. Those are the only 4 years of losses in the last two decades, but they're pretty substantial. So you'd want to be sure before investing that this is not something that's going to be repeated, and you might want to spend some more time reading the 10Ks of these years to understand what the drivers were for that, because this isn't necessarily a typical recession. For instance, in 2020, 2019, 2021, the COVID years, they actually did quite well. So it's not like a recession on its own is going to cause this, but it's something to be aware of. Now, what's really strange is how you jump up from this basically earning very little return on capital from 2012 to 2014 up to earning a significant 26% in 2015. 26% return on invested capital is a very good number. 28%, very good number. All of these numbers up and around 15% plus are very good, which they held from 2015 to 2020. Now, the last 2 years at 9% and 8% is a little bit more poor, but still probably getting us a very strong return in terms of our return on equity, which we're seeing both already in the double-digit range from there. But certainly something to be aware of what's going on here. You know, they must be increasing their asset base significantly to have that big drop-off. This looks like an average company, doesn't scream high quality. The fact that it's able to hit really high return on invested capital numbers, which is what I expect with the digital distribution of video games company, is very good. But the fact that it's not sustained is a little concerning. That it doesn't seem less predictable. Now, if we fast forward 15 years and the 15 years in the future look all like this and none of this, then it would be a very good investment. But it's hard to tell based upon the chart of data that we have here. You really want to understand what their future looks like. Their gross profit margins, EBIT margins, free cash flow margins, 20-30% here, 73% here, all signal a pretty high quality company, which is why I'm concerned about some of this past history, because it doesn't match up. The 10-year median returns look really good. 18% return on invested capital, 22% return on equity. I like to buy when return on equity is above 15, return on invested capital above 10. You're meeting all those metrics. The main concern is what's going on in this history, and we're going to dive a little bit deeper into that. Now, the PE ratio of 40 here seems very concerning. That's an extremely high PE ratio that I would never want to pay. So what would make it interesting? It would be interesting if the current earnings are lower than they otherwise should be, and that would be one reason why you might see an abnormally high PE ratio. So if we do a quick check on this, so you have 130 here, you divide by 40, let's call that 325 a share or something like that is what it's saying our earnings are. 2021 you had 287, 276. That matches up there. You're earning $3 something here. So you are trading at a pretty high multiple. 2020 is exceptional at $10.30, but I'm going to guess that this number is coming from some sort of one-time item. And when we get into the income statement, we're going to be able to get a better idea of what's going on there. Could be something throwing that number off. You didn't really pay dividends for 8 years, but it looks like they just started one in 2021. So it's nice that you're going to have some dividends going forward. One of the things that's really interesting that they are doing is they're turning a 5% revenue growth into a 30% EPS growth, free cash flow growth. That's amazing and probably not sustainable. And I think part of that has to do with your 10 years ago, you were in this 2012, 2013, 2014 range when they were earning hardly anything. And you see these operating profit numbers of 84 million basically break even. And it looks like they were just at a part where they just weren't making any money based upon the overhead that they had. But the fact that they were able to grow their gross margin from 63% up to that 68% range meant they were able to start having a massive operating profit. And they became much more profitable. So it's also, these numbers probably aren't very helpful at all. What is a better look is to look from 2015 to 2022, and that's where it gets a little bit concerning. Because if you say 2015 you're at $2.69 a share, and you bought then, and then you fast forward and you're only at $2.76 a share, then over a 7-year period you basically went nowhere. And that's a concern. I mean, you spent quite a few years in the $3 range, and yet you spent the last 2 years in the $2 range. I don't like to see those sorts of declines. And again, it's not super predictable there. Why are you getting worse? We need to have a better understanding of what's going on in that business. Now, certainly they sell into the console market, and the console market is one of those things that is cyclical based upon generations of consoles. That could be one explanation for that, but it's hard to say simply based on the financial statements. If you're enjoying this video so far, hit that like button. Don't forget to subscribe. We're going to go into the income statement now to learn a little bit more about the business. So R&D has doubled, 1.1 billion to 2 billion. Not a problem there. SG&A is up 50%. Gross profits doubled. So again, not a big deal. It looks like they've really gotten over the hump. They really need this $3 billion in gross profit to cover their SG&A and research and development. And that was really the problem here, is that the gross profit wasn't covering their overhead for these 2-year period. Once they got the gross profit high enough, then it became less of a concern, and they've been managing the business well since then. Although it'd be nice if they were growing their overhead a little bit slower, because they've managed to keep up with their growing gross profit and keep their operating profit numbers down. I do like that I see that they've been buying back shares. They had 313 million shares outstanding. They're down to 286. So they've bought back about 10% of their shares over the last decade. It's about 1% per year going to add to your returns from those buybacks. That's always good to see. Now, one of the questions I had was this number here in 2020. We had a $10 per earnings per share number, and we can see that it's caused by this income tax line item. So the income tax line item of $1.5 billion really distorted what was going on here. And so we can safely ignore this $10 number because it's not a real number here. A real number would be somewhere, 1.5. So you'd have maybe a $5 per share. It would have still been a pretty good year. It would not nearly have been as good as it appears, though, because it's definitely being distorted by this income tax. Let's look at our balance sheet. You can see they've been building up cash. They have, $3 to $5 billion in cash on the balance sheet. It appears to more than offset their debt and liabilities. They have, basically cash equivalent to their total liabilities in 2021. That's a good number to see. Now, it's not as good in 2022, but still you have some pretty good numbers there. There's almost no PP&E in this business. I mean, you talk about $500 million in PP&E, and yet the income statement says they're making, $1.3 billion in operating profit. They're having a massive return on tangible capital here. So this is the sign of a really strong business. I mean, all the capital here is really in goodwill and cash. I mean, if you take out cash and you take out goodwill, this company's basically running on very little assets. A couple billion in assets. You're talking 20-30% returns on those assets, which is where you're getting these really nice numbers from. Especially these tangible assets are just not that high of an amount. Of course, cash is playing into what the calculated numbers. So it could be this is actually probably part of the problem, is they've accumulated cash over the last couple of years. And that's distorted their asset picture. I mean, they goodwill. So they made an acquisition here as well that jumped up the goodwill. So I actually don't have a big concern about this return on invested capital number that we saw here. Once you take that goodwill addition out, then you're in the double digits, and you've been in the double digits since 2015. So as long as you can be sure that 2015 to 2022 is the norm, then you can feel good about buying this stock from a quality standpoint. Their debt has been kept under control. You see this growing retained earnings once they hit that profitability mark. That's all a good sign. Everything there looks good. Cash flow statement. Depreciation, amortization, not too high. Yeah, these acquisitions the last 2 years are really what's driving this big gain in assets. Once you make those acquisitions, you're paying above what the PP&E, the tangibles are on that business. It's going to get added to your goodwill and stuck there. And so it's just going to inherently lower what your return on capital looks like. But the actual core business is very non-capital intensive. It's simply that they're having to pay up for their acquisitions that's driving that. And these acquisitions aren't a huge cost in terms of their overall market cap. I mean, $3, $4, $5 billion on a $35 billion market cap. I mean, you're talking about 15% of the market cap. Not a big deal. Cash flow from operations is very large. They're basically using a lot of the cash on share buybacks. The concern I have is that they've only retired 10% of their shares outstanding over a decade, but they've been dumping a lot of their money into share buybacks. It's a little bit of concern simply because they've not gotten anywhere with it. And I think the problem for them is that the share price is so high. So when you're dumping you're dumping money into buybacks at high PE ratios, it's going to be very ineffective. If you use the same money at a PE ratio of 10, it would have been substantially more effective. So, I mean, I like management using money on share buybacks because it allows investors to get in and out of the stock when the share price is cheap, sell when the share price is expensive, and you can leverage that. You get a leveraging effect from the buybacks during that time. But it still means that when the buybacks are not as effective, you probably don't want to even own the stock during that time. It makes it more of a trading mechanism if the stock trades at this high of a price. So that's really the problem for them here, is simply how high the stock is trading. So it's hard for me to know what to do with this business. I like the games industry. I think it has really good gross profit margins. I like the brands that they have here. It's very strong brands with EA, good returns on invested capital. I lean towards putting this on my watch list. Why am I hesitant? I think it's because this growth rate is really hard for me to predict. And I don't really know what's happening here. I think this goes on my watch list with the need for more investigation. I want to make sure that I'm not going to repeat this period, because this could simply wipe out a lot of shareholders' equity if you have 4 straight years of losses. So I want to be sure that I'm not going to have those losses. But if the future can look like the last 7 years, where you have these really amazing gross profit margins, where you have this operating leverage, where you're just growing your operating profits, when you're really leveraging these EPS growths, that's all good. A lot's going to depend upon how effective the acquisitions are that they just made. You'd require some more effort being put into that. But I like the core business here. You're getting very strong returns on tangible capital, 30% plus, and it doesn't even reflect that in these numbers. And so I'm really excited about that as a business that I would want to own. So for me, Electronic Arts would go on my watch list. It's too high a price right now. I can't pay a PE of 40. I would not be interested unless the PE was less than 20. So if we go to the income statement and say, what's the trailing 12 months, $3 something. So it needs to get under $60 a share. Once it gets under $60 a share, I think Electronic Arts gets interesting. At current prices, it's just a little high, but I do think it's worthy of being a watch list stock. So if you enjoyed this video, hit that like button. Don't forget to subscribe. Ring the bell so you get notified. I'm uploading new videos Monday, Wednesday, Friday, each and every week. I hope you will stick around to check that out. At the top, you're going to have a playlist of the 150 plus S&P 500 companies I've already covered. I think you'll enjoy some of those videos in there. Check out your favorites through that playlist. And if you want to learn how to use this software itself, if you want to get this to study companies, go to quickfs.net. The link is in the description below. It's the first link, my affiliate link. I encourage you to sign up to that affiliate link. Thank you for listening, and until next time, stop paying fees, start building wealth.